Good afternoon, everyone, and thank you for joining Victory Capital's webinar, Recent Turmoil Leaves Long-Term Fixed Income Opportunity. My name is John McCauley, and I'm the Retail National Sales Manager for Victory Capital, and I will serve as your host for today's event. I'm delighted to be joined by Jim Jackson, Head of Fixed Income Portfolio Management at USAA Investments, which is a Victory Capital investment franchise. Prior to Victory's acquisition of USAA Asset Management Company, Jim had joined USAA Investments in 2009 and has 20 years of fixed income experience. Jim's a graduate of the United States Naval Academy, and prior to entering the investment business, had served in the United States Marine Corps. Everyone has been muted upon entry, and the voice lines will remain muted throughout the duration of the webinar. We'll open it up to questions upon the conclusion of the prepared remarks and answer as many as time permits. If you desire to submit a question, please do so through the webinar control panel. To locate, you'll notice a small orange arrow on the right side of your screen, which allows you to expand the section. Directly below the audio option is a section titled Questions, where you may submit your inquiries. We'll address as many as possible, but if we're unable to answer all, we'll follow up with you individually. We're very excited about today's content as financial advisors and consultants seek new opportunities in today's fixed income markets, and many have embraced the USAA Fixed Income Solution Suite across both taxable and tax-exempt due to its philosophy of constructing yield-focused, tax-efficient portfolios built bond by bond through fundamental analysis, which historically has led them to outperform peers consistently over the long term. And to share today's agenda, Jim will spend approximately 20 minutes on how yield is the primary driver of fixed income returns, the opportunities and the challenges that are present in today's fixed income market, and also how our disciplined investment process helps to identify those opportunities. Then following his remarks, we'll host a 10-minute question and answer session. So at this time, it's my pleasure to turn the webinar over to Jim Jackson.
Thank you, John. It's a pleasure to be here with all of you today. I will start on slide 3, and this chart is basically the philosophical underpinning of how we approach fixed income. What this shows is that under a duration targeted portfolio, that the primary driver of returns is the starting yield. So as you can see here, over an extended period of time, we show the starting yield of a portfolio on the blue line and the subsequent 6-year return on the green line. So as you can see, the correlation is very tight. Obviously, there are periods where it deviates slightly, but it always returns back to that sort of long-term return line. So this, our philosophy is based on this sort of research that we've done. There is seminal academic research that supports this as well. And we are firm believers that income drives long-term returns. So when we build our portfolios, we focus on the generating incremental income to both the benchmark and our peer set. So as I move on to slide 4, this I think is one of the most interesting charts that we put in this slide deck. What this shows is treasury yields and credit yields, which would be the green line and the purple line. So as you can see, over a very long period of time, this is not news to anyone, is that the yields have been falling since 1980, roughly, or so. So the interesting part of this chart is the relationship between yield on the Bloomberg Barclays Credit Index and the yield on the Bloomberg Barclays Treasury Index. So after 2007, 2008, the relationship between those two has increased, which what I mean by that is that the yield on the credit index as a multiple of the Treasury index has been elevated relative to what it's been since 1980, and it's also become more volatile. So I'm sure you all recall in 2007, 2007, 2008. The Fed intervened in the market pretty dramatically. Treasury yields have been held low for an extended period of time. So if yield generates returns and Treasury yields are very low, obviously your prospective returns over time are low. So what we've seen recently is that with the onset of COVID-19 and the Treasury intervention in the market, we've seen Treasury yields plumb to all-time lows. So the relationship between credit yields and Treasury yields has spiked to all-time highs. So this chart here is through the end of March. Obviously, there's been a lot of movement since then, but that relationship still exists, and it is still near all-time highs. So the relative opportunity in credit still exists, and we think that incremental yield advantage is what will drive stronger returns for credit over time. So this chart is meant to address there's typically a concern when investing in credit that the correlation between credit and equities is fairly high. So this chart here shows rolling 3-year correlations of the Bloomberg Barclays Credit Index, the Bloomberg Barclays Aggregate, and the S&P 500. So as you can see, the correlations are really tight over time. There's been a small dislocation going into the end of March, but looking over an extended period of time, the credit index and the ag are highly correlated to one another, as you can see by the green line at the top. They are almost perfectly correlated, in fact, and that they both are or have been for the last 10 years negatively correlated with the S&P. So the message here is that if the concern is that credit correlates highly with equities, the historical evidence does not prove that out. The historical evidence states that it gives you a similar diversification benefit relative to the ag. So this chart here shows that this is actually one of the, I think what this shows is just the starkness in recent movement of credit spreads. So this chart is showing U.S. aggregate credit spreads from 2001 until 2020. And this is through the end of March. So what happened during March when credit spreads widened significantly? They have risen to a level that had not been seen since the global financial crisis. So since that time, we've seen credit spreads improve dramatically. So you see here the peak that they've achieved relative to the long-term average. Well, now spreads, if we extended this chart out another month, it would still be barely noticeable because the movement wider and tighter has been so dramatic. So right now, credit spreads sit roughly where the long-term averages sit, but that invites a question that what is the opportunity now? So obviously the best opportunity to invest in credit is when spreads peak. However, once spreads peak and start to tighten, you tend to experience excess returns for an extended period of time. So as we move to this next chart, what this is showing is credit spreads over an extended period of time, that is represented by the green line, and the blue shaded in line are the forward 1-year excess returns. So the amount of excess return relative to treasury bonds for similar duration portfolios. So what this chart tells us is that the historical evidence shows that once credit spreads peak and start to decline, that you will experience not just excess returns generated by the improvement in credit spreads from the peak, but those excess returns will persist over multiple years in most cases. Why does that happen? Well, that happens, one reason is obviously the improvement in spreads will increase the price of bonds relative to treasuries. The incremental income that is added will improve return relative to treasuries. And then once credit spreads start to decline, that decline tends to persist for an extended period of time. So once credit spreads even meet their long-term averages, they tend to tighten through that, so that roughly 2/3 of this time period, credit spreads will be below their long-term averages. So right now, even though credit spreads have tightened pretty dramatically in the last month and a half, the historical evidence shows that once it meets the average, that is just the start of an extended period of time of excess returns relative to treasuries. So our view when USAA builds portfolios is that our focus is on using our extensive credit research and experience to build portfolios bond by bond, so that we can add incremental yield to what our peers are offering and what the ag or other common benchmarks offer. And we do this knowing that over time, what is going to drive those excess returns is the incremental income that we can generate. So this has been our philosophy for as long as I've been at USAA, which is 11 years now. I have multiple colleagues that have been there for 25 years. The philosophy was there when they started. So this is simply who we are. This is how we manage portfolios, and that this philosophy and approach has been consistent for decades. So this income focus is how I think it differentiates us. It forces us to focus on what our core competency is, which we view as evaluating, taking, and managing credit risk. But it also allows us to focus on what our core competency is not. So our portfolios, depending on the mandate, will have or driven by the mandate, they will have a duration target consistent with its benchmark. So what we aim to give you is a interest rate exposure similar to the benchmark, and we don't aim to take bets on where interest rates move, what the shape of the curve looks like. We simply aim to provide you with a duration profile consistent with your goals. And given that, we then try to construct portfolios that add that incremental income that's been proven to drive returns over time. So you won't see us in our portfolios taking large macro bets that are really binary choices that will drive the returns over time, because those decisions will overcome any sort of income that the portfolio generates. The way that we view it is we are making in every portfolio hundreds, sometimes thousands of individual bond by bond credit decisions that will drive our returns over time. So this focus has filtered into how we build our team. So this is the chart for our entire team. As you can see, the largest team that we have is our credit research team. Their experience is broad. They cover every credit-focused fixed income asset class, from structured products to high yield to munis to corporates. And our portfolio management team, every member on that team was a credit analyst, not just somewhere else in the industry. They were a credit analyst on our team. So our focus on credit is what drives us. It's what drives how we construct our team, and it's what drives who populates our portfolio management team. So this team that you see here has an average of 23 years experience, and I think most importantly, an average of 17 years on our team. So even though I've been at USAA for more than a decade, sometimes I still feel like I just got there, given the level of experience and tenure on our team that we have. So this last chart that I'll cover on a more formal basis is our basic approach and process to how we manage fixed income. So this is obviously a Pentagon shape as a nod to our service, to our historical mission of serving the U.S. military. And I'd like to focus on a couple different parts of this. One is the credit research portion. every bond that we hold in the portfolio, we maintained an independent credit rating on. So we do not rely on Moody's and Standard & Poor's to provide a credit view on the bonds that we hold. We have a specified methodology to rate every type of bond that we hold in the portfolio, and we maintain an active credit rating on everything we hold for the entire time that we hold it. So we always have a current active view on the credits that populate our funds. The other part that I like to focus on is risk. So our risk process is robust. It starts with understanding the holdings in our portfolio. There is a specified cadence that every single name in the portfolio is reviewed from a credit standpoint. All of our funds have specified duration targets so that we're not taking more or less interest rate risk than the benchmark, so that we are delivering to our clients what they expect from a risk, from an interest rate risk standpoint. And we focus on the aggregated risk of the portfolios. Obviously, we are going to be very credit intensive relative to our peers and to the benchmark. What comes with that is an extensive evaluation of the underlying credit risk of the bonds we hold, and an extensive eval of the aggregated credit risk of the entire portfolio. So the risk process is really run from the CIO down. That is a key part of what he is looking at on a day-to-day, month-to-month basis. So the final slide here is just an overview of the funds that we manage. It's a fairly straightforward product suite. All of these funds with the have a credit focus to them. Even our government securities fund has a 20% basket of non-government or non-U.S. government bonds. So we will take advantage of our taxable muni team. We will hold AAA munis. We will hold very high quality product that can add some incremental yield to that fund. So it's pervasive across our team as far as, and across our funds, the credit focus. So with that, those are my prepared remarks. And John, I think I can turn it back to you and we can take some questions.
Sure. Well, thank you, Jim, for your insightful remarks on the fixed income landscape and the opportunities that are present within. The first question that's coming through is what are your expectations on defaults moving forward and the overall impact this will have to both investment grade and non-investment grade bonds?
Sure. Thanks, John. So defaults have been obviously a very topical item. There's been several high-profile defaults that have happened post-COVID. So right now, what we've seen is that the U.S. high-yield default rate has reached a 10-year high at 4.85%. Shortly after the shutdown started to happen, JP Morgan increased their default expectations for high-yield bonds to 8% for the year. That was probably 2.5 times what it was prior to that. The theme that we've seen thus far is that the companies that have defaulted are those that had weak business models going into this. So a small, in this case, a very large decline in demand has pushed those companies over the edge. So we've seen names like JCPenney's, which has been migrating towards a default, seems like for the past 10 or 15 years. We've seen Hertz, who a few years ago engaged in some aggressive financial transactions to take its how it finances its cars off the balance sheet and minimize the number of assets that they've held on balance sheet, so they could take sort of more aggressive financial actions. So right now, what we're seeing is, and also multiple companies in the energy space. So right now, the defaults have been very much focused on companies that had weaker business models going into this. So Right now, this is something we're monitoring very closely. Obviously, we were happy to see so far some better numbers as the U.S. economy has opened up. But we do view this as a time where our credit research should shine. So who are the companies that have durable business models? Who are the companies that have access to capital to get them through this time? And who are the companies that from a credit standpoint have managed their balance sheets well prior to an economic downturn? So we are very much leaning on our credit research team to provide us the insight and the research needed to navigate through this market.
Great. Thank you, Jim. The next question is, with the Fed printing money and entering the corporate bond market, what implications does this have on the bond market?
Well, that's a great question, John. I think there's a multiple part answer to that. In the very early part of the onset of the COVID shutdowns, the fixed income market was struggling, and it was not just struggling on a credit standpoint, it was struggling on a treasury bond standpoint and very much focused on the short end of the market. So the Fed's initial actions were designed to sort of shore up the very short end of the not just the treasury market, but the corporate bond market as well. And we've seen that work. So we've seen bonds are trading, bid-ask spreads have tightened, and the significant dislocations on the short end of the market have mostly resolved themselves. I think that was a big positive for the market. It allowed the new issue market to open back up, so that the sort of medium-term impact is that it allowed companies that were experiencing what is hoped to be a short-term drop in demand to raise cash to tide them over until the economic situation is more normal. And we've seen that. The issuance to date has it's been record levels. There's been more bonds issued in the investment grade space year to date than were issued all of 2019. So those first two, I think, are positive results of the Fed intervening. Now, the longer term implications are more complex. Obviously, companies in both the high yield and investment grade space are going to be more levered going out of this, meaning they're going to have more debt relative to the amount of earnings that they can generate. And how do companies respond to that? Do they have a more conservative financial policy to actively reduce debt? Does demand come back at a sufficient level in order for them to service their debt? So those are things that we're constantly looking at. I also think it's resulted in some companies who simply would not, even though they may have been able to issue some debt in the market, they simply would not have been able to service that debt. So they were already over levered going into this. So some of those, like Hertz, chose to simply file to restructure now rather than wait 6 months to do it then, right? So it's so I think the longer term implications of what the Fed has done are still working themselves out, but it was very much do you save the patient while he's having a heart attack, or do you worry about a longer term problem now, right? So I think they just very much focused on solving the problem at hand, and we'll be dealing with the consequences of it over the coming years, certainly.
Fantastic. Thanks, Jim. Next question is more specific on the muni end. So over the last few months, local and state governments have seen tax revenues and budget shortfalls. So what is the overall state of the muni market, and where do you see the best opportunities? The muni market experienced the same type of dislocations that the rest of the credit markets did. There was but what we've seen over the last 6 weeks or so is that the muni market has sort of come to
an uneasy normal, right? So fund flows are more stable now. Rates have fallen substantially from the highs. Local economies have started to reopen. Credit spreads in that space are still elevated. We think, though, that this presents opportunities for our seasoned research team and seasoned PM team to enhance the long-term returns of the portfolio. So the muni market is very idiosyncratic. So our funds do not buy a lot of what they call GO bonds, general obligation bonds of states. We tend to do a lot of credit work on bonds where we can generate more yield, where having knowledge of the individual credit actually pays off in us generating a stronger return for our shareholders. So that market is very difficult to put in generalities. So for example, for the corporate market, we can say, well, energy bonds are going to do poorly or they're going to do well based on the price of oil. In the muni space, the correlations between credits within sub asset classes is lower. So you can have a hospital that's in a rural area that is struggling, and you can have a hospital that's in a robust urban area that has a dominant market share that is going to do well. So that is an area that is that we think doesn't lend itself to just picking the AAA GO bond. That very much lends itself to rolling up your sleeves and doing the individual credit work and picking bond by bond, because there are such significant differences between individual credits and individual bond structures that the driving returns in that space is very much reliant on deep credit work of our research team.
I think we have time for one final question, Jim, and that question is, can you give an example of what makes USAA unique when buying certain types of bonds versus its peers?
Sure. I think that what differentiates us is our credit-intensive bond-by-bond approach that focuses on generating income. We don't weight industries or credit exposures versus an index. We think that is suboptimal, and that you end up with the largest debt issuers being dominant portions of your portfolio. We think that invites incremental risk to our shareholders. So we don't weight versus the index. We don't try to drive alpha by making macro bets, and we don't deviate from what our core competency is, which is evaluating, taking, and managing credit risk. I think we're very cognizant and confident in what we're good at and what our core competency is. But on the flip side, we're also very aware of where we can't win. And where we can't win is making the macro bets, making those big bets on different parts of the interest rate curves. That's not where our core competency lies. We do the credit work, we add incremental income, and we stick to our process, and we're not concerned about looking different or being different than our peer group. We're most concerned about sticking with what we know we're good at and sticking with our process through the credit cycle.
Thanks, Jim. And it does appear that we've approached our 30-minute time period. So for those of you with outstanding submitted questions, we will follow up with you individually. Jim, thank you very much for your commentary, very timely and relevant. Just a couple important takeaways in closing pertaining to the fixed income credit markets as described by Jim. First is, historically, yield is the primary driver of fixed income returns, and the relative income advantage of credit is at a high, which often precedes excess returns. Second is, credit-focused portfolios, such as those managed by USAA Investments, provide similar diversification benefits to the traditional indices with an ever-persistent yield advantage. USAA's experienced team of portfolio managers, analysts, and traders employ that consistent income-focused philosophy, as Jim described, built bond by bond to deliver very competitive long-term returns across various duration structures, both taxable and tax-exempt. And from a size perspective, The USAA fixed income solutions reside in that sweet spot with sufficient AUM to see and access everything while also being nimble enough to purchase bonds that potentially bloated AUM peers are unable. And finally, all of this translates down into their pre and post-tax peer rankings, with many USAA fixed income solutions residing in the top quartile or top decile, inclusive of taxable and tax exempt, over the trailing 5 and or 10-year periods. So if you do require additional information, as Jim had shown the slide earlier, please feel free to contact your respective Victory Capital sales director, or you may also contact the Victory internal sales desk at 1-800-991-8191. Thank you all very much for your time this afternoon. Have a great evening, everybody.